Welcome and thank you for joining today's webinar, New Trends in Finance, Views from Venture Capital and Asset Management, featuring Alex Kayyal, Senior Vice President and Managing Partner at Salesforce Ventures, Chantal Noble Haldorsen, VC Lead at Centeras and an active angel investor, Shayan Hussain, CFA, Managing Director and member of the multi-sector fixed income product strategy team at BlackRock, and Marc, Chair of the Boston University Department of Economics, our moderator. My name is Marianne McChesney from the Boston University Alumni Relations Office, and today's webinar is presented by the BU Alumni Association. I'm delighted to see that this webinar has attracted alumni interest from near and far. Alumni from 34 states are represented, including Massachusetts, Maine, Vermont, and Rhode Island, to Florida, Virginia, Alabama, California, Washington, Ohio, and Michigan, with too many more to list. Our global reach has extended to alumni joining us from 24 countries. Major international cities include Rio de Janeiro, London, Singapore, Mumbai, Sao Paulo, Istanbul, Cairo, and Kazakhstan, and that's just naming a few. We hope you all enjoy today's discussion. But before we get started, I have a few housekeeping notes. Today's presentation is being recorded and will soon be available for on-demand viewing in the Alumni Association website. We will send you a link shortly after the program has ended. Also, Alex, Chantal, Shayan, and Marc are looking forward to answering your questions at the end of the discussion. However, please feel free to submit your questions at any time using the Q&A box. You can find this box by hovering your mouse over the screen, locating the Zoom toolbar, and selecting Q&A. It is now my great pleasure to turn the program over to our moderator, Marc Rysman. Panelists, you can turn your cameras on and your microphones, and we'll turn the program over to you. Thank you.
All right, wonderful. Thank you, Marianne. It's really exciting to be here with these dynamic and exciting alumni that I have. I definitely want to encourage people to post questions. We're going to try and leave a substantial amount of the hour that we have together for answering questions. So just kind of fill up the box and we'll try to take them on. Okay, so Marianne already introduced our panelists, but I want to start off by just giving them a minute to talk about themselves. And let's start off with when you describe exactly what you do and give us a sense of your perspective on this. So on my screen, I see Chantal first, so I'll start with Chantal.
Yeah, thanks so much for having me. You can hear me okay? Great. Yeah, so I am the VC lead at Centeras. Centeras is the largest investor globally in travel, tourism, and hospitality, with just over 7 billion AUM. Traditionally it's been private equity, distressed credit, and real estate, but more recently we've launched venture investing. So our portfolio today has over 30 travel brands, which include TripAdvisor, Hertz, Amex Global Business Travel, a few brands most of you have probably heard of or used at some point. We do over $100 billion in total transaction volume on an annual basis, which means there's a lot of opportunity to explore partnerships with earlier stage startups that could really benefit from our network distribution and scale. So I focus primarily on Series A and Series B opportunities that fall within our sectors where we feel that we can add tremendous value and be strategic partners and investments.
Great, and do you want to? You also listed on that introductory slide angel investing. Do you want to talk about that for a minute too?
Sure, yeah. So I'm a very passionate angel investor. I've written over 30 checks to date. I really like being involved in the trenches and around day one. And so, that spans a little bit, it's a bit more sector agnostic. So I've done probably a third of them are within healthcare, a lot within women's health, but also fintech, food tech, some travel, and a few other categories. But I try to help founders kind of debunk and demystify what we put them through on our side of the table. So it's my way of kind of giving back, I guess.
So the angel investing is you putting your own money on the line instead of Centeras. And are the investments typically like stuff you come across as part of your work for Centeras, and then they're not ready for VC yet, or is it just totally separate?
It's a bit of a mix. I've been doing it for a long time. And so, as previously, and we'll get into that later, but at an early stage consumer fund. And so doing more consumer deals there, that sort of continued. I end up getting a lot of inbound through founders I've invested in previously. But there are also cases where, it might not be a great fit for Centeras, but, I think it's interesting and, still want to participate.
Yeah, it sounds amazing. All right, Shayan, you're next to my screen, so why don't you go ahead.
All right. Hey, so thank you very much for having me on. It's really nice to get connected back with the BU community. And so a little bit about myself, 2000 graduate from CIS and SMG, but pretty much lifelong in fixed income, which you don't hear a lot of people say, but it's been a passion of mine, which is also another thing probably you don't hear a lot of people say, but I'm just always really attracted to the asset class. It's just very quantitatively based in nature, but started on the sell side with JP Morgan, trading interest rate swaps for some time, and then moved to the buy side with BlackRock. So I've been at BlackRock since 2009. So it's been quite an experience, but always within this role as a strategist for the fixed income team. So I work directly with our CIO, global CIO of fixed income, and my role as a strategist, I'm more of an outward-facing member of the team. So I spend a lot of time meeting with clients, and kind of walking through what are their views. And I'm sure all of you have been paying attention to, I think the Fed is trending very high in terms of searches, interest rates, inflation, pretty much all my world. So it's we've been very busy in a lot, geopolitical risk and whatnot, and everything taking place. But that's really what I do, is kind of a representative for our global fixed income team, meeting with pensions, endowments, family offices, investors globally, to kind of walk through our views, how we're managing portfolios. And really, we invest across all areas of the public fixed income markets, from govies, US, globally, emerging markets, getting into more esoteric areas like securitized areas of markets, CMBS, residential mortgages, the wide gamut from a public perspective. So a little bit on the private side, but for most part, my experience primarily lies in kind of public fixed income markets. So it's an exciting time to be in the space, at least for the moment.
So you listed yourself as a product manager. Does that mean you're designing new funds that BlackRock is marketing?
Yeah, it's a good question. So by virtue of having so much interaction with our investors, you kind of get a sense of what the trends are, what people are looking for, what are the challenges that most folks are facing, what are the risks that people perceive in markets, what are the type of products that may be well received among investors. So that is a part of the role as well, in terms of saying, hey, folks are worried about inflation, folks are worried about capturing yield. How do you solve for that? What are the different tools that you can use? What are new products that we can deliver to solve for unique investor needs for today's environment? So we do a good amount of that as well, for sure. It's a great point, Marc.
Right. So I think of like where Chantal and Alex are picking particular, companies to invest in, or stuff, let's say companies to invest in. Your role is more thinking about more generally where the investors want to go next.
Yeah, it definitely lies in more kind of broad macro trends, thinking longer term investing, proper asset allocation mix. What are the risk factors in underlying portfolios? What do you want to accentuate versus maybe de-emphasize, given the opportunities and risks in the market? I'd say that's how I would characterize it.
Sounds great, thanks. All right, Alex, why don't you describe what you're doing?
Yeah, it's great to be here, and excited to reconnect also with the BU community. Feel very proud to be part of the BU kind of alumni base, so excited to be here. I'm with Salesforce Ventures. We're the venture capital arm of Salesforce. I joined the team about 7 years ago, initially to start Salesforce Ventures in London, and then relocated about 5-6 months ago to be in San Francisco. We started investing, if you think about kind of Salesforce's history, initially started in '99, kind of before cloud computing was even a thing. And so we've always had kind of an ecosystem DNA in the business, kind of a rising tide will lift all boats. Probably the best example of this might be the company's kind of app exchange, which you can think of as like the iTunes for the enterprise, kind of a B2B app store. And so we always had these really interesting software companies working alongside Salesforce. So about 12, 15 years ago, we started investing in those companies, recognizing that actually we can help them above and beyond capital. And that was kind of the initial light bulb moment when we realized we could partner with some really interesting companies, kind of reinventing the future of software. Fast forward today, we manage about $5 billion all from the company's balance sheet. We've invested in over 300 companies, really globally. I think Marianne mentioned 24 countries are on this call. We're at a similar number. We've backed entrepreneurs in about 26 different countries all over the world. And we pretty much focus exclusively on software companies. Just given our nature and our DNA, that's where we think we can be the most helpful to the entrepreneurs that we back, and where we have the deepest kind of perspective and conviction when making these decisions. And then we do it across stages. We start at kind of the Series A when companies typically have some inclination of what their product is going to do and some early traction with customers, very low single digits kind of revenue. But then we go all the way to kind of pre-IPO investing as well, where we're investing in kind of more category defining, really pre-IPO companies. Zoom is actually a good example. We're on Zoom today. We invested in Zoom just before their IPO. And so very different nature there in terms of kind of the stage of investing, but we're able, because of the kind of flexibility in our model of investing from kind of a more evergreen permanent capital balance sheet, it's very patient capital. And so we can be pretty flexible in terms of when we team up with entrepreneurs. So that's kind of what we did at a high level. My path to venture was almost by accident. So after, in some ways, always loved kind of investing in tech, but the two worlds collided really after I started my own company. So after BU, I actually went into investment banking, started my career at Merrill Lynch, then went back to school, went to grad school, did an MBA, and then started my investing career. And I was doing more late stage kind of private equity style investing. Loved the kind of intellectual rigor of private equity, but was kind of missing the innovation and kind of the opportunity to back entrepreneurs directly. My father had been an entrepreneur himself in the small business sense of the word, not in the tech sense of the word. So always in our family, kind of entrepreneurs were revered and kind of celebrated. So I actually left that world to go start my own thing. And that's when those two worlds collided. And I realized actually venture capital would be a career choice for me. So very lucky to do what I do and kind of accidentally stumbled on this path.
So Alex, just starting back at Salesforce, is like a successful investment for Salesforce Ventures an acquisition by Salesforce at the end, or is it an IPO where that comes with and then you're selling out, or what is the kind of goal? Are these companies that are kind of on the Salesforce platform typically?
It's a great question, Marc, and it's evolved a lot. I think at a high level today, the goal is let's invest in the most disruptive kind of successful software companies. Whether they get acquired by Salesforce or not is definitely very kind of secondary and almost an afterthought. I think if you look at the track record we've had so far, we've had about 125 companies that we've invested in that got sold, and only about 10 or 15 of those have been acquired by Salesforce. So, what we tell entrepreneurs is surely the stars align, and over time, the two companies kind of can get to know each other very well with an investment. But really, the types of entrepreneurs we're backing are the ones that want to build really big businesses, have aspirations to define their category and kind of change the industry from what they're doing. And so actually, if it does make sense for Salesforce to acquire, great, but more importantly, we want them to build really big, successful businesses.
All right, I think everyone wants to hear a little more about just how you got here. So if you can start back at your major at BU and maybe the next few steps. And a few of you, Alex already covered a little bit of how he got where he went, but I kind of want to start even farther back than where you started. Chantal, can you tell us what you were doing at BU and what your next steps were and how you ended up in your current position?
No, definitely. So my path has definitely been a windy one. I double majored in econ and psych at BU. Graduated in 2010. Actually, while I was an undergrad, I was working in a cadaver lab at a medical device company, and as much as I like healthcare, that was a bit much for me. So, kind of sprinted into business, and so I joined EMC, where I ended up spending 6 years and had an incredible time. So, First was working on integrating companies we acquired. So EMC had grown by acquisition, acquiring something like 70 or 75 companies in the course of, I believe, 15 years. And so building a framework around how we would do that, how we would integrate, Salesforce teams of, thousands of people in some cases, and have a bit of a streamlined approach to that. So kind of built out that machine, as I call it, in the US, and then we rolled it out globally. So I had the opportunity to have a very entrepreneurial experience within a large corporation. The last 3 years I was there, I worked in sales strategy. So around the time where EMC was shifting from being a hardware focused company to selling, software license agreements, consumption on demand, that type of thing. So worked on retraining our customers on how they were buying and our salespeople on how they were selling, and had to do a lot of the back end office work as well, and working to create new SKUs and supporting the legal process. So got to see kind of end to end of a sales process, which was really exciting. But Dell announced they were buying EMC, and I had been thinking a lot about, what else is out there other than corporate life. And like Alex, went to business school, and it was like day one for me. I discovered the world of startups and have never looked back. Started helping my peers who were, much smarter than me, starting their own companies, but helping them with, go-to-market strategy and naming their companies, and going through their pitch decks and realizing I was, maybe kind of good at figuring out, what was a good one and what was a not so great deck. And so, then thought, how do I turn this into a career? I ended up joining an early stage consumer fund after business school, doing seed and Series A, called Torch Capital. And then I ended up joining Centeras at the end of 2019, joining a travel focused investment firm right before the pandemic. It has definitely been a really interesting ride, but yeah, I definitely wouldn't go back and change it. I changed the pandemic part, but not the Centeras part. Clarification.
That would be good. Yeah, if the pandemic was tough on department chairs too, I'll mention, but Shayan, can you fill us in a little bit?
Yeah, no, happy to. So my where I started at BU, I came in with a good amount of the AP credits in econ. That was just something I was really excited about, and just something I was really passionate about. And yeah, that was I leaned into that, and that was my major. And I was actually gonna graduate early, and then I learned about the BU COP program and decided it'd be a cool pairing to enroll in SMG. So I did the dual degree program, and really enjoyed the complementary nature of, the theory and kind of the broader big picture that I was getting via econ, and maybe kind of the nuts and bolts that I was getting from SMG. It was a really nice complement. I didn't know what I wanted to do, so it's interesting. It's been a long, windy path for me, as Chantal mentioned. But I started out actually in telecommunications. So I worked for AT&T. That was my first job out of college, and I was in a few different roles. I worked actually in their venture arm for a little bit for Bell Labs, but then also worked in investor relations, did public debt offerings. I worked on the spinoff of AT&T Wireless, worked on the sale of AT&T Broadband to Comcast. So worked on some pretty interesting transactions that, I think really changed the face of the industry. But then I realized, okay, we took the whole company apart. Now what do I do? So finished the CFA program. I decided I want to move into capital markets. So, started with JP Morgan on the interest rate swaps trading desk. Did that for a few years and realized that it's not the thing for me. It was cool, but not. I need to be more long-term investing focused, aligned, less transactional in nature. Is just kind of how I'm wired, I would say. So it's interesting, exactly like Alex and Chantal. I went to business school and was able to kind of realign. I probably went to business school at the exact wrong time. I went from, depending on your perspective, but I went from 07 to 09 to business school, which great time to be on the sidelines, which is fantastic. Not the best time to get a job after business school, but as fate would have it, I just got connected with the right people, and was just kind of networking on the asset management side, and a little known company called BlackRock popped up, and I met the right people. And I said a little known. They weren't little at the time, but no one was really paying attention to BlackRock. I was the only person from my class that went to BlackRock, and there was no formalized recruiting program. Now it's much more structured, but yeah, I just kind of found this kind of area where the passions align, like, you know, the macro econ side and fixed income, and you know, just being aligned with long-term investors, and you know, ultimately working as a fiduciary to clients. That's something that we talk about a lot at BlackRock. It really resonates with me, where you don't have this ulterior motive. Maybe sell side, you can debate as to committed motivations, but I really do like that kind of full fiduciary responsibility and just ultimately doing what's best for our investors. I think that's day in, day out. That's what we do, and that's what really gets me excited. So it's been a long path. I had zero clue what I wanted to do after BU. I knew I had a great time and I had got a great education, but it was a winding path that, you know, I think life has its way of working, of just pointing you in the right direction, I suppose.
Thanks. Alex, you talked a little bit about your path already, but do you want to fill in any blanks?
Yeah, definitely some parallels and differences as well, with some kind of, definitely resonates with Chantal and Shayan were saying there. I think, you know, I guess to rewind the clock a little bit, I was actually born in Geneva, Switzerland, which is kind of where the UN, you know, European kind of headquarters for the UN is, the World Health Organization, you know, huge kind of government affairs kind of community there. And so actually when I went into BU, I thought I was going to study international relations and kind of go into that track. Diplomacy kind of appealed to me at a kind of, you know, history and intellect kind of, you know, political relations level. And so joined actually initially kind of College of Arts and Sciences to do that. And I still remember the first time I kind of walked in to take, you know, as a requirement to be an IR major in your first year, you had to take introductory kind of micro and microeconomics. And those two classes kind of blew my mind. It really opened up a whole new interest level that, you know, I feel very grateful for having done those two courses. And subsequent to that, I actually ended up doing a kind of double major with economics and really doing a lot of coursework in finance. You know, sort of fell in love with the quantitative nature. I had always been very analytical, and kind of understanding how businesses and capital markets worked sort of really appealed to me out of undergrad. And so got very fortunate, you know, joined Merrill Lynch out of undergrad. You know, I think similar to Shayan, not a particularly structured program, definitely had to knock on a lot of doors to get that chance, and was very grateful for that. Initially worked in the kind of CFO's office, where it was everything from thinking about investor relations reporting to how do we automate kind of our trade risk exposure. And then after about a year of doing that in New York, moved to London on the investment banking side, where I was actually part of the real estate and consumer retail team. And, you know, at the time, that was one of the strongest teams at Merrill Lynch. You know, I really liked kind of the group I had met. It was a bit of a black box where you sort of indicate your interest level as an analyst and they indicate theirs. You know, different teams kind of have this almost sort of dating process in the first couple of weeks when you join, and then they allocate you a team, and kind of those stars aligned in that direction. And two things kind of were really clear to me. One is I didn't want to be in investment banking forever. I really loved the initial kind of learning curve. You know, it was kind of incredible the types of exposure you would get as a, you know, early 20-year-old out of college. Pretty amazing experience, but you know, my interest lied elsewhere. And after about 4 years, you know, I guess I got a little bit luckier with my timing. I did business school 09 to 11, which was, you know, I remember the time I applied for business school was actually just when Bank of America acquired Merrill Lynch. And we, you know, in that weekend, actually, it was right in the middle of the financial meltdown. You know, had it not been for Bank of America, Merrill Lynch might have not even existed anymore. You know, we'd kind of seen what happened with Lehman Brothers. So a lot of turmoil. And it just felt like going back to business school was a really good time to kind of take a step back and learn some new skills. And, you know, that was a really, you know, kind of very transformative experience for me as well. I think, you know, in undergrad, obviously, you're kind of opening up your horizons and really trying to figure out what you're interested in. I think business school allowed me to kind of double down on the things that were really appealing. And investing really stood out. You know, I'd always been into kind of tech. As I mentioned, you know, had kind of learned to code in my teenage years, but never really connected the dots. And when I started investing, I loved the kind of intellectual curiosity of what it took to be a great investor, and kind of that lifelong learning of, you know, developing your kind of frameworks for becoming a better investor. But really missed the kind of innovation piece and the kind of energy of the entrepreneur. And that's kind of ultimately what led me to venture capital. My first job in venture capital was, again, certainly a bit of luck, but a classmate of mine from business school had actually joined this fund. And we were, you know, close friends in business school. And so when I mentioned earlier, I'd done a startup, when kind of I was ready to move on from that, he pinged me and said, hey, we're actually looking to hire someone. You're interested? And so just kind of had one conversation led to another, and that was my kind of initial entry point into venture capital. So definitely feels like quite windy, I guess, to the other panelists, and a lot of luck along the way, which I'm very grateful for. But I guess the kind of ultimate thing was really trying to follow some passion and things that I was really excited about it, and also walking away from stuff that oftentimes was less interesting. I think obviously kind of going from private equity to starting my own company was not an easy decision, kind of walking away from a pretty cushy, comfortable job. So I think, sometimes when you really follow your kind of instincts and what you're really excited about and gets you out of bed, things can sort of over time work themselves out. So very grateful for that.
Great, thanks. So of course, I just hear 3 econ majors. And then there's some other classes they took, I guess, but obviously economics played a big role. So for folks, I guess folks don't know, but I had Chantal and Alex as students in my undergraduate course in antitrust. So it's really great to see them here. So let me kind of turn to like what you're doing. I'm really curious about how you make your decisions. For Chantal and Alex are picking investments, and how do you choose where you're going to make your investment? Is it the team that you're looking into? Is it a feeling that it's going to work? And I'm really curious about the role of data analytics in your decision making. As you may know, BU is like investing really heavily in data analytics right now. We've got this big building going up. It's the biggest one BU has built in 60 years, devoted to computer science and statistics and economics. Has really been investing in that as well in terms of what we're offering. So I'm really curious to hear you talk about kind of the tension or different roles that data analytics plays into maybe these other decisions. And then we'll kind of turn it to Shayan, whose decision-making is a little different in terms of the decisions he's making, but I think the same issues are gonna come up in how we ask. So Chantal, why don't you go ahead?
Yeah, definitely. So it's absolutely a mix of things, and the earlier you go in terms of stage, it becomes more and more about the team, and a little bit less about the underlying financials, as they're I'm not supposed to say, but basically made up when you're looking at a super early stage company. But from our perspective at Centeras, it's definitely a little bit of a mix. I can't put gut on a slide, and so I need to be able to communicate to my investment committee why something is worth making a bet on. And so I'm very fortunate in the sense that the Centeras infrastructure really provides me with a lot of support. Number one, you mentioned analytics and data. I think you can only imagine with the companies we have in our portfolio and touching millions of travelers every single year, there's a lot of data that can be useful across our portfolio as our companies look to kind of help each other out and benefit from insights that others might have, but two, to help us make smarter investment decisions. And so what I didn't touch on earlier is when I first joined Centeras and the pandemic hit, took a little while before we could start investing earlier stage. And so I was able to take advantage of getting to ingrain myself in our portfolio, get to know the different players at various management levels within the organizations, as well as figure out what kind of data I could get my hands on. That has proved really useful now that we are investing earlier stage. So I'm currently a team of 1 doing venture, but I work really closely with the private equity deal team that has extensive experience within travel, hospitality, and mobility. And so being able to tap someone who was the CEO of Sabre to join one of my calls with the founder, or leverage insights from a portfolio company when I'm trying to make a decision and validate the value proposition of a company is immensely valuable to me. But zooming back out, when I'm looking at a Series A opportunity, the team is incredibly important. There's you need to have a TAM and addressable market opportunity that can support venture returns, and then there are basic fundamentals you need to look for, as is this solving a real problem, and are they going about it the right way? You know, understand the unit economics and whether they can scale. But you know, when you're looking, you know, earlier stage, you need to be investing in people who will figure things out when nothing goes according to plan. And you know, anyone who invests in venture knows that things usually deviate from plan. And so I'm looking for that capability to adapt and, you know, really importantly, hire around a founder's weaknesses. So, you know, I look for founders who know their strengths and where they excel, and know their weaknesses, and can really build a robust team around themselves, as opposed to trying to be everything to anyone, which, you know, just frankly is impossible. And then, you know, from the Centeras perspective, I'm really focused on where we can add value, whether we are, you know, creating mutually beneficial relationships with our portfolio, whether that's through, you know, our distribution channels, or whether our portfolio companies can be early adopters of a technology or other types of partnerships within our networks. We don't really look to invest unless we feel like we can have significant influence and accelerate their growth.
Alex, you want to give a perspective on this?
Yeah, I mean, that resonates a lot. I think Chantal summarized a lot of kind of the venture DNA nicely. You know, I think a few points I'll add. I mean, I think kind of venture capital for, you know, clearly is a game of outliers. You know, I think if you look at a traditional fund, it's typically a very small number of companies that will account for the majority of the return. So, you know, unlike a typical, let's say, private equity fund where every deal consistently, you know, you're hoping to do like a 3 to 4x return, you know, in venture capital, it's much more skewed. And you know, ultimately, the question we're trying to ask ourselves when we're investing here at Salesforce Ventures is, can this be one of the most important software companies in the world? You know, we really hold the bar high in terms of, can this be a generational business that's going to stand the test of time? And when you kind of have that lens of, you know, really how big can this get, and how disruptive can this be, it's a really exciting framework, because I think, you know, to Chantal's point about the team, there's all sorts of different team DNAs. You know, you have some founders that are, you know, straight out of college and really just have a kind of vision for something and just bring a real passion. You have other founders that, you know, this might be a 30-year career in a domain, and all of a sudden, after 30 years of really being in an industry and knowing all the players and seeing why it's so broken, they just have a real impetus to go change it. And so there isn't really a one size fits all from our perspective in terms of team. It's more about ultimately, you know, the aspiration level of trying to change something that's really fundamentally broken. I think the only other 2 points I'll make is, you know, one, in venture capital, it's really just as much, you know, you're asking about how we make decisions, but it's also just as much how the founders decide us. You know, unlike in public markets investing, if I want to go and invest in a public stock, I don't have to convince the CEO of that company to take my money, and I can just, you know, go and take that position. In private land, and particularly in venture capital, you know, the entrepreneur gets to choose, and the best founders really have choice. You know, there's obviously been a huge amount of funding in the ecosystem, tons of dry powder, and, you know, for those really best in class companies, these rocket ships that are gonna, you know, get to significant kind of milestones, they get to choose who they work with. And so a huge part of our thesis is not only like, how do we pick them, but also, you know, venture capital fit for us. Like, are we the right partners for them? And what are we going to do to really be in the back kind of seat, supporting the entrepreneurs to make them successful? And so sometimes that gets lost on folks, and it's, you know, even when we're doing diligence, it's a bit of a two-sided process. You know, we're getting to know the company, but they're also getting to know us. And every interaction, I think both sides are getting to know each other, and that's a really important part of the job. And then the last point I'll mention, just around kind of how we make these decisions. You know, for us, the importance of kind of being values driven is super, super important. You know, as a company, Salesforce kind of pioneered some incredible values, and one of the most important ones is equality. And where that translates for us in venture capital is, you know, historically venture capital has not been a particularly diverse industry, and it's actually pretty shocking how poor it is from that perspective when you look at kind of gender diversity or ethnicity and kind of where the venture dollars go. And so we're being very intentional and kind of active about trying to change that, and it's something I'm really proud of in terms of our team's effort. And a great, just kind of to bring it home in terms of how this manifests. You know, we'll often look at Glassdoor. If you're not familiar with Glassdoor, it's kind of a job posting site, but really it's a showcase of the company's culture. You can go in there and type in any company, and you can see, you know, anonymized reviews of a CEO and a management team. And we've oftentimes walked away from investments that we thought would be fantastic financial returns, But just from a values perspective, we identified certain parts of their culture which might have been toxic or just didn't speak to the values that we uphold as an organization, and decided that wasn't a good fit. So kind of the last part of that decision making is, hey, is this someone that we think we want to be in business with, and that articulates those values in a way that we would be proud to kind of support.
Oh, it's amazing. Students pick my classes based on my class evaluations sometimes, I think. So I guess that's my closest thing. So, BlackRock is making different sorts of decisions, but they're always, I think of BlackRock really evolving their processes to generate performance for investors. And I'm curious how you see that, and what is the role for kind of technology and analytics in that space?
Yeah, no, it's amazing, since 2009, the evolution that I've seen in terms of the business structure and investment processes, and also for that matter, the type of talent that we're hiring. So there definitely is a data bent to a lot of folks that we're bringing onto a multitude of investment teams across the platform. When talking about public markets, I think similar to kind of private markets, I think your brand in the market, your connectivity in the market, there's a benefit to scale, and particularly in public markets, but to that end, sourcing is key, and where markets become more efficient, where you have, the right relationships globally, there's some really cool kind of off the beaten path opportunities in fixed income, where we can actually reverse inquiry and structure deals on behalf of our investors and on behalf of, people looking to finance things. So whether it's, Amazon looking to finance a warehouse in the middle of America somewhere, stuff like that, you can actually invest alongside long-term trends, but it's a matter of having those relationships in place. We spend a ton of time talking about sourcing and how do we get a kind of increase our advantage in sourcing. But on the technology side, I can't say enough about that. I mean, a huge part of our business is Aladdin, which is our risk management systems. But, and if anything, the last few months are a great example of that. You can have the best idea in the world, but if you haven't structured it appropriately, and if you haven't sized the risk appropriately in portfolios, it may lead to an outcome that may not be aligned with your stated objectives. So we spend a lot of time thinking about portfolio structure, and along those lines have been really kind of building our risk management teams. I think at this point we have 2,100 developers at BlackRock working on our Aladdin systems. The other thing I think you'll find really interesting, so actually I'm based in Atlanta, which is, BlackRock's in New York, but building up teams here in investment teams in Atlanta, but we're actually building out kind of data-oriented investment professionals. So we think there's a lot of opportunity in kind of alternative data sources like credit card data. So, you can look at the retail sales print, you can look at, where CPI is printing, or you can actually look at fundamental corporate data, transactional data, more real-time data that gives you a leg up in terms of economic forecasts. And, obviously, forecasting can make a difference. So we've actually built a team here in Atlanta. It's about 15 plus folks that are staffed to basically optimize around building alternative data sets, literally around whatever's trending. So if it's mortgage rates, used car prices, gas prices, crypto, whatever it may be, we can build these kind of alternative data sets. So a great example, we actually, this team built some cool data sets, scraping Reddit data from, Wall Street Bets, ANC, GME, and that data was actually used for alpha generation purposes. So that's the type of stuff that we're talking about. So more and more common is on the resume, like, do you know Python? That's like, I feel like when I get a job, it's like, do you know Excel? Like now it's like, oh, do you know Python? Do you know other programming languages? The other thing I would say in terms of data sets, ESG is becoming more prominent. So exactly, to the point about investing in an individual company, similar investing in sovereign debt, you want to know their social governance, practices. So, you want to know their environmental practices. And, ultimately our view is more and more ESG factors are having very real economic implications and therefore investment implications. And you are seeing it start to get baked into the risk premium across different areas of the market. So we are building up a lot more kind of capability from an ESG perspective and integrating that into credit analytics. But, there's a lot of good data when it comes to ESG. So we're oftentimes building that ourselves and piecing together, different data points. Like we built some great stuff around the municipal bond market. not a lot of great public data, but we've been able to kind of piece together some really cool sources. But we think that's going to play a much larger role when you think about that shift of capital towards sustainable investment. You're talking in the hundreds of trillions of dollars, right? It's a massive amount of money. It's going to have very real implications for investing. So we're spending a lot of time investing there and thinking about the data that we're using to inform those decisions.
That's
Hey,
amazing.
Shayan.
Go ahead.
Sorry, Marc, I was just going to say, that's super, super interesting. And actually, one thing I probably should have mentioned is last year, our biggest investment category was actually in like the next generation data stack. So companies that are, whether it's BlackRock or tons of other companies in the world are trying to, invest in to make sense of all that data, because it's so much to do and so much to kind of decipher that it's actually been our biggest investment category. So super interesting to hear some of the places that you all are pulling that in and trying to kind of, leverage that to make smarter decisions.
Yeah, well, in the economics department too, we're trying to use textual analysis to do for economic research. And overall, it sounds like maybe BU's investment in data analytics is well spent from a perspective of training students for people like you. I want to definitely leave time for questions, so I'll just give you like maybe just really quickly, we can kind of run through, what do you see as the biggest change in kind of what you do, like in your industry or in your area? What's like the biggest change you feel like is going on right now, or maybe, it's like going on right now? And obviously, the pandemic looms large, but whatever you want to point to is, I'd be curious to hear it. Who wants to jump in first with that open-ended question?
Sure. I'd say in venture, you're seeing, I mean, there are a lot of moving pieces right now, but I'd say venture investing is becoming a bit democratized in that you previously, it was not accessible to the average person to get into an early stage round, but now regulations have changed and there's a lot more access. So you're seeing people putting together rounds on AngelList. You're seeing a lot more business angels and just, people raising micro funds and getting into what is often considered, a hot deal, even without being a big brand fund, because entrepreneurs are seeing the value that those investors are bringing. On the travel mobility front, obviously a lot of change. The pandemic really accelerated the transformation from what has been kind of an analog offline experience a lot of the time, whether you're checking into a hotel or renting a car, anything that's involving face-to-face interaction and maybe didn't need to. We've seen a huge shift, right? So the post-pandemic traveler is not interested in standing in lines, not interested in sitting and waiting on the phone. Everything needs to be on demand. You need contactless transactions. You need to be able to do pretty much everything on your phone when you're in a hotel, renting a car, whatever it is. And so that's something that we are obviously tracking really closely. Within mobility, a lot of shifts towards EVs, and so that's something that we are super focused on. It's great to see from a climate perspective, and from an investment perspective, there's also a lot of opportunity because you can shift a fleet. You can buy 100,000 Teslas, but that requires infrastructure and a lot of software and support to facilitate that transition, to get the average consumer renting a car, for example, getting comfortable doing so, and making sure that we're having seamless experiences. So we use the Hertz example a lot of we view what was previously very much going and standing in line at a desk and renting a car. Now you should be able to verify that you are who you say you are on your phone, get into your car. Hertz should be able to know where that car is at all times, and the consumer should know exactly where they need to go to charge that car, and just have it be a completely seamless interaction. And so that's just the rental car example, but something that we're focusing on across every vertical within travel.
Yeah,
I'm happy to jump in next. I'd say kind of three things that come to mind in terms of what we're seeing. I mean, one, I think, is just the explosion of the asset class in the last 10 years. So last year was a record year. Around 300 billion was invested in venture capital in the US, and about 600 billion globally. So just staggering amounts. And just to put some perspective on that number, 10 years ago in the US, it was less than kind of 20 billion, right? So over 10x growth in 10 years, and what used to be called more of a cottage industry, certainly not the case anymore. So I think just the sheer explosion in capital that's available, and that obviously also translates into the kinds of investors that are investing. I think it used to be venture capital was very few firms were taking that kind of risk capital and taking those early stage bets, and now you're seeing a huge proliferation where even hedge funds and corporates and a long list of kind of institutional types are getting exposure to the asset class. So I think that's kind of one interesting trend. Another one is obviously the current environment we're in now. I mean, it's no surprise, pick any tech stock, the last kind of 3-4 months, you've seen things come down, and particularly in software, kind of 50-60% from their peak. And so just a real valuation adjustment right now. Obviously, the inflation environment, the geopolitical situation we're in, is certainly creating a lot of overhang there. And obviously, in the low interest rate environment, tech stocks were seen as a really attractive place to be. So just there's been a fundamental kind of reset, I think, in valuations and in how people are thinking about the kind of the venture price to pay for an asset today. And then the last point I just mentioned briefly, we're still early here, but obviously the whole trend around crypto and Web3 from a decentralization perspective, I think is super interesting. If you think about kind of the internet economy, when it started in the 90s, now to how it's concentrated in a very small number of players, there's a real opportunity for kind of crypto and blockchain to really open up a lot of industries. And I'm curious to see how that'll influence funding for companies. You can imagine a world where actually venture capitalists are almost altogether bypassed. And this kind of a funding round is raised almost in a decentralized way through a blockchain network. So still very early days there, but kind of interesting to see some of the changes that are happening.
Thanks, Shayan.
Yeah, two things I would note. First, you've probably seen in the news, but we've been making some pretty considerable investments from an ESG perspective and sustainable investing, and it's wild. I mean, look at the numbers. In terms of reaching net zero by 2050, that's going to require roughly $125 trillion of investment in net zero technology. So, point being, there's a massive move in capital, and you look at a lot of our largest clients have made commitments to net zero. And if I just look at those clients, those represent roughly $130 trillion of assets of AUM globally. So that's a mega trend in which we're making considerable investments and also shaping our portfolios and including in our investment processes. The other big trend broadly, I would say, is ETFs, which is not necessarily a new thing, but I would say what the new thing is using ETFs as financial instruments. And that's particularly important in the fixed income market. So you think about the fixed income market, a lot of bonds don't even trade in a day, right? So it's pretty wild where, you look at LQD, for example, which is our investment grade ETF. Most of the bonds in the underlying basket trade like 5 times per day. LQD trades tens of thousands of times per day. So it's turned into this amazing financial instrument that we use in our active portfolios. And you're seeing a lot of other asset managers integrate into their process because you can't source that liquidity. March of 2020 is a great example. The market seized up. You couldn't even trade treasury bonds in March of 2020, which is the most liquid asset class. That's your risk-free rate, right? Should be able to trade that in any environment. You couldn't trade it. There was no treasury market. It was by appointment. The wild thing, you look at like ETFs in particular, you actually saw the volume go up. So it actually served as a point of price discovery. So it becomes this relief valve from a liquidity perspective. So, in the midst of that kind of March 2020, LQD went from a discount of 5% to a premium of 5%, within a week. So it's introducing a source of liquidity for investors to better manage risk in portfolios where, when you look at individual securities, particularly in more challenged environments, maybe harder to trade, it becomes an interesting relief valve and source of kind of risk management. So you're seeing a lot more adoption among asset managers. From a regulatory perspective, insurance companies now can include ETFs as a financial instrument. So the rate of adoption has increased exponentially, particularly within fixed income due to the relative illiquidity of the asset class. It introduces a very liquid risk management tool. And just the general ecosystem around it. You look at the ADV that's traded on a daily basis. You look at the options market that's developed around these products. it's changed the game, I think, in terms of, fundamental investing and the tools that are used. So that's a bigger trend that we've seen in terms of the utilization of these instruments.
That's awesome. All right, so a couple of you highlighted interest rates. So I'll ask the question more directly. Matthew asks, how does rising interest rates affect what you do? How is that affecting your decisions?
Shayan, do you want to take that?
For me? Yeah, that is a great question. So two ways on answer that question. I think obviously you want to be more defensive right now. Inflation is running high. It's and the Fed has to move. And in fact, and Marc, I'd be curious your thoughts, but the Fed is painting itself into a difficult corner, right? You've accelerated inflation, and actually growth is moderating now. You're coming off a very elevated level, so the Fed has a difficult position. The growth, the full employment side of the equation, and the inflation side of the equation. What do you value more? So we do think, we have been more defensive in terms of managing interest rate sensitivity. But then you get this narrative, like a lot of folks saying, well, why do I hold bonds? Is it the death of the 60-40? I mean, you got to take a look at the rates that you're getting, how much interest rates have recalibrated. It's actually pretty interesting. It's actually creating some really interesting levels. So like a traditional core bond portfolio, like you look at one of our actively managed, it's yielding 4% at this point. Front end IG is yielding closer to 3% at this point. So I think there's been this interesting recalibration where a lot has been baked in around the views around inflation, the views around the Fed, where it's actually creating some really interesting entry points. So we have been defensive, to answer your question, but actually, the recent vol and recalibration rates has actually created some cool investment opportunities where there's a saying, there is no alternative in public markets. Well, now there kind of is an alternative, right? You can get 240 on 2-year treasury notes. Just a year and a half ago, it was like 20 basis points. So there's some cool ways you can get some nice yield in a lower risk way. That's a lot of what we're looking at in terms of shifting portfolios.
Alex, did you want to take that question too?
I think the biggest thing for us is just the valuation environment and what that translates into. I think a great example of this is actually the term unicorn, which I'm sure many of you are familiar with. Used to describe a startup worth $1 billion plus. I think it was coined around 2015, kind of 2014, and back then it was called a unicorn because it was so rare. And I think at the time there were probably 10 of these $1 billion plus companies. Fast forward today, and actually let's look at kind of 6 months ago before the kind of current period we're in now. Unicorns have become almost a commonality where every company that we were seeing was getting funded at astronomical levels. And unfortunately, there was just so much momentum and so much kind of, excitement, I'd say, for kind of the venture capital industry that a lot of companies were raising at very frothy valuations. And so a lot of that kind of steam has come out of the system. Obviously, as going back to the point earlier about public stocks being down 60-70%, I think investors are really questioning entry point and what an asset is worth. And so I think what you're seeing is a real fight to quality in our sector, where all of a sudden it's not just growth at any cost. Growth used to be really rewarded by public market investors, and Snowflake is a great example of that. One of our investments continues to have a kind of one of the highest multiples in software just because of that high growth at scale. But there's really a shift now also in terms of cash flow and kind of efficiency. All of a sudden, it's like not just how fast you can grow, but how do you get the profitability and how can you grow efficiently? And so I think we take the view that even in a kind of high inflation environment, there's still great companies get started even in the most turbulent times, right? So if you take a kind of long-term view, the reality is innovation doesn't sleep because of inflation. Companies still need to solve hard problems. We talked about the data stack a few minutes ago. Like none of those problems go away. Really, the question is, what's the kind of clearing price for some of these things? And as you think about kind of terminal value long term, how much are you willing to pay? And so I think that's where we've kind of reset. And we always have a high bar in terms of when we're investing, but I think we're really challenging ourselves amongst the partnership of, hey, how special is this asset, this company, and do we think it has real defensibility and a large market opportunity? And if the answer to those questions are still yes, we're still investing. If anything, at just more attractive prices.
Tal, is that similar for you?
Yeah.
Was interest rates affected, Chantal? Is interest rates affected what you're doing, or you just look long term and?
It's definitely something that we're super mindful of as well. But yeah, I mean, we've been watching for a while what's going to happen to valuations, and you know, we've been waiting for a correction for quite some time. And you know, inflation aside, I think this is overdue. And so, you know, it's definitely just making us, exactly like Alex said, more prudent in terms of what we're willing to pay. You know, again, earlier stage, you're still looking at a lot smaller numbers, but when you have some of the major players coming downstream for a long time now, you know, Tiger, Cotu, and friends, it's been a challenging environment. And so for anyone that, you know, is being a bit more prudent about valuation. And so I think now maybe it will end up being like a slightly more even playing field as everyone pulls back a little bit and maybe is thinking twice before jumping in on some of those rounds.
And maybe one point to add on that, I think, and it relates to kind of what Chantal and Alex do. When thinking about rates, and our thought there, obviously inflation elevated and will be higher just due to scarcity as a function of the world that we live in now. Like geopolitically, the whole world has dramatically changed, and resourcing is going to be dramatically different, scarcity is going to be different, inflation, slightly higher inflationary regime. That doesn't take away from the fact that there's these longer term trends at play that keep us in a lower inflationary regime than what we've seen historically. Number one of which is demographics. So we have an aging population. Longer term, there's a high correlation between demographics, level of growth, inflation, and interest rates. The second thing is technology, and that's something we talk a lot about. So you look at the disinflationary impact of technology and what, you know, Alex and Chantal are doing. I mean, with the level of disruption, you know, the level of cost efficiencies are gleaned. I mean, investments are being made in technology, not from the perspective of higher prices, but from the perspective of lower costs and greater efficiencies. And, you know, if anything, you know, that appears to be accelerating in nature, just given the new, you know, range of technologies that are being introduced. So, yeah, so we're not of the view that we move into a dramatically higher inflationary regime, albeit maybe moving to a moderately higher kind of range than where we were pre-COVID.
All right, great. I think we're running up against our clock here, so I'm going to turn it over to Marianne. I really want to thank Marianne for helping us set this up, and Greg Carlo, and of course, our panelists, Alex Shayan and Chantal.
Absolutely. Well, unfortunately, we are constrained by time, and I want to be mindful of yours. It is 1:57. We're wrapping things up, and I first and foremost want to thank you, Alex, Chantal, Shayan, and Marc. It was fantastic to hear your insights on the industry from your area of expertise. And of course, it was fantastic to learn about the path you took to reach your current roles. Thank you for supporting Boston University in this way. I also want to thank our audience for taking time to log on, listen, and ask great questions. We hope you learned a lot from the discussion, because I certainly did. I also want to take this time to thank the many donors out there who support the good work and valuable programs at the university. You help make this institution a rich environment for students, faculty, alumni, and friends. And for that, we are truly grateful. We look forward to having you join us again in the future. Please keep an eye on the BU alumni calendar for upcoming events, and check back as programs are added on at a regular basis. And again, thank you for your time. Take good care and enjoy the rest of your day.
Thanks for having us.
Thanks, everyone.